Good morning, Chairman. We're now live.
Thank you, Tom. Good morning, ladies and gentlemen. Welcome to this meeting of the Pensions Committee. Apologies for absence. Tom.
None received, Chairman.
Thank you. Item 2, declarations of members' interests. Obviously, if you've declared this on a DPI, then you don't have to declare, but if you feel you should, raise your hands, and indeed, if you find something on the agenda later on that you may feel is a declaration of interest requirement, then you can do so at that time. Steve Larter.
Thank you, Chairman. Declaring interest as an active and deferred member of the Lincolnshire Pension Fund.
Thank you, Steve. Mark Allen.
Chairman, I'm a member of the and get payments from the Lincolnshire Pension Fund.
Thank you, Mark. Tom Hodgkin.
Yeah, I'm an active member of the pension scheme as well.
Thank you, Tom. Any others? Okay, thank you for that. Item 3, minutes of the previous meeting held on the 13th of July. You should have all read them by now, and it starts, the number on the bottom of the page is page 5, so page 5, 6, 7, 8, 9, and 10. Are there any matters arising that are not on the agenda that you wish to pick up on? Okay, could I have a proposer that there are a true record of our meeting on the 13th of July, please? Thank you, Steve Money. And a seconder, please. Thank you, Peter. Peter Coupland will declare that a no. Can we have a show of hands, please, that they are a true record? You got a problem, Tom?
I think I was absent from memory, Chairman, and it's not on the minutes. I can't see that my apologies were given, and I definitely gave them.
Okay. With that amendment, please, can I have a show of hands that they're a true record? Any abstentions? That will be 2. Paula will be abstaining because you weren't there. Yeah, exactly. And Steve Larter. Thank you for that. Anyone against? Right. The minutes are passed. I'll sign these all off with Tom here later on. Moving on then to the 4th item, responsible investment update. Can I hand over to Joe, please? Take us through that. Thank you, Joe.
Thank you, Chairman. So this report brings to the committee details of the fund's responsible investment activity during the first quarter of 23-24. It does have a recommendation that the committee consider the report and discuss the responsible investment activity undertaken during the quarter. Information on the engagement and voting activity from LAPF, Board to Coates, Robeco and Legal and General Investment Management is included within the report, and a number of appendices are attached to provide further detail. There is just one area I'd like to draw your attention to, which is paragraph 8 on page 18 about the stewardship code for 2022-23. As you'll recall, the fund was successful in 2021 and 21-22 in being approved as a signatory of the stewardship code. And attached to Appendix F is the submission for 22-23 for your information. This looks back at what the fund and its managers have done over the year to meet the 12 principles set out within the code. This will be submitted to the FRC in October, and we hope to hear whether we've been successful in retaining our status in February next year. So I'll be happy to take any questions on the report. Thank you.
Questions, members? None seen. Joe? As Joe rightly pointed out, there is a recommendation to discuss the RI activity. Does anyone wish to discuss the RI activity? Nope. So we'll take that as read. So the recommendation that the committee consider the report and discuss the responsible investment activity undertaken during the quarter. Nothing discussed, so we'll move on. Okay, thank you. Item 5, the annual report on the fund's property and infrastructure investments. Again, it's back to Joe. Thank you, Joe.
Thank you, Chairman. This report sets out the performance on the property and infrastructure elements of the fund, and it has a recommendation that the committee note the report. The main points that I'd just like to bring to the committee's attention are that the fund is currently underweight its allocation to property, which has had a positive impact on overall fund performance over the last year, but this is being addressed through the agreed investments into Border to Coast Global Property Fund and an increase in the investments in the UK residential property. The property portfolio will be rebalanced to the new allocations agreed at the June Committee over the medium term. Performance of the UK commercial property funds over the year has been mixed, with only Royal London outperforming the benchmark. The worst performer, Aviva, is in run-off as it sells its remaining holdings. The property venture funds and overseas holdings shown at paragraph 4.3 are all in the final stages of winding up. Unfortunately, due to the timing of the initial investments there, which was in the run-up to the global financial crisis in 2008, performance has been disappointing across all of these. And it's too early to comment on the performance of the UK residential funds as they're in the early stages of their investments. And then just finally, on the infrastructure, all the investments within that area continue to perform well. So I'm happy to take any questions on the report. Thank you.
Any questions, members? Yes, Tom?
Thank you, Chairman. With the obvious issues at the moment around the property market, especially the residential market, especially in the UK, how are we taking that into account when we invest in that fund, and are we potentially moving things into a slower pace of investment because of that? Because, as you say, you look at that market at the moment and wouldn't want to invest too heavily in it at the moment because it's, excuse me, it's clearly at a low point in the market, rather than at a point where we would want to invest to generate funds for the pension fund.
The two investments we currently have are both in the residential private sector rental. So one, if you recall, is the shared ownership type, and the other is the rented properties, but in smaller properties, not big units, not big tower blocks, etc. They will look at their expectations of the forward-looking property market as they buy properties, as they're doing those investments. It's not till we put the money in, it all gets invested in one go, it is drawn down over an investment period. So the new fund that we look at may be an additional fund from one of those managers. That's our expectation, but the timing of that, we will take advice from the investment consultant. I don't know if, David, you've got anything you'd like to add to that?
Yeah, so I suppose in terms of the longer term strategic case for the residential holdings, there's still a chronic shortage of housing in the UK, so there will be a kind of continued demand. Also, in terms of the current outlook, the kind of higher interest rate environment that we're in at the moment means that it may be, again, harder for people to get on the property ladder. So the types of residential property, the PRS investments and the shared ownership are, again, might become more attractive and actually a greater investment opportunity given the current position as well.
Thank you. Mark?
Thank you, Chairman. I better ask a question or two, otherwise this meeting will go too quickly, won't it? Is there... It must have been always quite difficult investing in particularly residential property because of so many aspects of it being led by government policy to a great extent in terms of properties that have been built and targets for properties and achievement of those targets, never mind interest rates, never mind all the things that have been loaded onto residential property resulting from climate requirements. And all those things, seem to be changed almost at a whim, or as a result of a prime ministerial speech at 4 o'clock, was it 4 o'clock or 4:30 yesterday? How do we actually cope with that because of those difficulties? Because, what the investment decisions that we make, and the basis for those decisions can change almost instantaneously.
Yeah, absolutely. There's always regulatory risk in most of the investments that we make, and we expect any managers that we appoint having a forward look at that and to have borne that in mind when they make these investments. But absolutely, policy can change very quickly. I think the key thing, and you'll have heard me mention it a million times, is we are long-term investors. So we aren't in it to make a quick turn. The investments in property that we're looking at, exactly as David said, that is an area that is very much understocked. You know, there is a high requirement for property. People cannot afford to buy, so they have to rent. The areas that we're going into, we're not looking at areas that generally have assistance from government, so it's not social housing, it's not affordable housing, it's kind of the middle area. But absolutely across all the investments, regulatory risk and regulatory change is always a consideration that we expect our managers and our investment consultant advise us on that as well. So again, David, I'll hand over to you if there's anything to add further.
Nothing really to add. It was the point on the managers that I echo. You employ specialist managers in this area. That's their kind of day-to-day is managing and trying to negotiate the minefield that can be the legislative environment. So it's making sure that you engage with the manager, that they're on top of the shifting landscape as it happens. But there still will be that kind of persistent demand and the strategic case to provide this kind of property and ultimately make a return from it as well for the pension fund.
Please do.
Thank you very much, Chairman, for your indulgence. We frequently talk about long term, you know, we're in it for the long term, and you know that is quite right to a certain extent, and you know even so underperforming areas may well change, you know, over that longer term, and indeed we have to be aware that stuff that's overperforming or performing in line with expectations may change as well for the reasons that we've just been talking about. But when we talk about long term, what are we talking about in terms of long term? Because some of the people in the country would have us believe that the long term is probably not very long.
So as an LGPS fund, we are still open. We have new contributors coming in all the time. Somebody coming in now at 20 might live to 90. So for them, long term is 70 years to make sure we can pay their pension over that time period. 10 years plus is kind of, I think, on investment long term. If you're looking at how long should you really give an investment manager time to prove whether or not they can do it, it's going through that full market cycle. So 5 to 10 years. But say long term as a pension fund, unlike our private sector DB schemes that are all in closing down and selling off, insuring out their assets as they're closed to new members, we are still open, and as long as the LGPS is open, our long term moves every year for another year because we've got new members coming in, building up pension.
You're off. Turn it on.
Sorry, I think you're missing the point I was talking about. You know, so, when I'm talking about long term, I'm not talking about long term in terms of expectations as we know them now. It's wrong to say even as we know them now. I'm talking about expectations in terms of where society may be over the longer term. You know, this is what ESG is all about to a certain extent, and trying to actually deal with the aspects of climate change and all the rest of it. But some in our society would say that unless we make significant changes in the way that we live, there won't be society in the long term.
Yeah, and I think my response to that would be, which is why we see the ESG element of our investments, being a responsible investor, as so important, so that we are looking for long-term sustainable investments that are feeding into, be it the green agenda, be it net zero, be it improving water standards, be it improving working conditions in companies. All of these things that we look at through the ESG lens, as discussed as mentioned in the previous paper, are there to try and ensure that we do have a place that people can live in over the medium term. So I'm not sure how else I can answer that, because unfortunately I don't have that crystal ball to say how long we're going to be here for.
No, and maybe we need the bubble over the UK to actually help satisfy that requirement. Thank you.
Thank you, Joe and David, for that. Mark, I know your question wasn't about this, but just as a matter of interest to help a little bit on the actual how long do you define for investments, basically dealing with DB schemes, defined benefit, is different from defined contributions in the private sector, and the estimation through both the FSA as it was then, the FCA as it is now, was that you should be looking at a minimum of 5 years to for an investment based. That's also a compliance thing. I know that wasn't your question, and I know it wasn't geared around that, but I just thought I'd mention that.
No, Chairman, and with due respect, it's not necessarily an answer either, because, you know, defined benefit schemes, you know, require investment in income into them, and, you know, that's what Joe was alluding to in relation to people joining the scheme all the time.
Yeah.
But there are significant taxpayer inputs that are taking place to the schemes as well, and that is required, and if that's not there, there will be difficulties.
I think that's a fair point. The only thing I would say for newer members is that what we are aiming to do as Lincolnshire Pension Fund is to ensure that we're at least 100% fully funded. What does that mean in reality? It means if everybody was to retire tomorrow, we could pay everybody's pension. That's not likely to happen, but that's the thing. We're at 109% at the moment, fully funded, I think I'm right in saying, thereabouts. We're over 100 anyway, which is good news, obviously. So we're ahead of the game in that sense. There's no reason to be compliant. But we're talking about fairly long-term investments for people, given the fact that, you know, a normal retirement, I think now for you officers, is around about 55, isn't it?
That's the earliest age of retirement.
I know you're way off that, Joe, but...
That's the earliest age.
The earliest, yeah.
But Chairman, we're 100% or 109%, which is a very good position to be, on the current valuations of those investments.
Absolutely right. It's a movable feast, obviously. You know, especially in the equity market, you can get massive drops here and there. But when you're looking at the spread over a number of years, generally speaking, over the long term, yeah, absolutely right. I think we could have this debate for quite a long time, but I'll try and close it there. Any other questions, first of all? The committee are asked on page 89 to note the report. All those in favour, please show. Thank you, that's unanimous. Moving on. Item 6, investment pooling consultation. Joe, back to you.
Thank you, Chairman. So this report provides an update on the government's consultation on investment pooling, and it has a recommendation that the committee consider, discuss and approve the draft response on the consultation LGPS Next Steps on Investment.
Could I stop you there, Joe? That's an important statement that Joe has made, the recommendations. Think about that recommendation there before Joe carries on, because at the end we're going to ask you for a response.
So the committee are aware of the latest consultation from Department of Levelling Up Housing and Communities that was released on the 13th of July, which set the direction of travel for asset pools and investments. Paragraph 4 sets out the key points raised, and that this should be seen as a three-stage process of transition to pools, collaboration across pools, and then consolidation of pools. The summary of the draft response from Border to Coast, which will be considered by the Joint Committee next week, is set out at paragraph 6. And if you have any comments or questions, please forward them to Councillor Strengle so he can raise them at that meeting. The draft response from the Fund, which echoes a lot of what's in the Border to Coast response, as I've been involved in the working group to ensure that the Border to Coast response does meet the requirements of the underlying partner funds, but our individual fund response is set out at Appendix A. And paragraph 7 in the paper identifies some areas that the committee may wish to discuss. And these are the issue of fund consolidation. Now, it's not included in the response. Border to Coast haven't included anything on actual fund consolidation. There's a lot of discussion about it, particularly with the London funds. Some of the partner funds have mentioned it in their responses. I haven't pulled it in at this point, but I can put something in about it if you would like. I think the danger in talking about fund consolidation is where's the line where funds are too small and should therefore consolidate. So as a £3 billion fund, we are definitely not one of the larger ones. So that's for the committee to decide whether they would like me to include anything in there, because that would, say, particularly for the London boroughs, where the London CIV, their asset pool, has struggled to gain momentum in getting investors in, and there are 32 funds across London. The second one is on the private markets element. From the pool's response, they've talked about their offerings in private markets, what they do there. Now, we don't use border-to-coast private market pools. We use Morgan Stanley, who will be coming in later on the agenda today to talk about how they're investing on the private markets for us. So I've taken out the references to all the benefits of using border-to-coasts private markets, as at this point in time they don't have the full capability of what we require in managing our private markets. There's 5% that was talked about in the initial guidance that could be retained outside of the pool for geographically local investments. This hasn't been mentioned in the updated guidance, but some pools and funds are referring back to that. I haven't mentioned that, as Lincolnshire has always had a policy not to do local investments. Within the consultation it talks about levelling up and local investments, but that's referring to local being UK. So I haven't included any reference to that initial geographically local investment of 5%. And then the response to question 4, which some of the funds have put in, and proposes remunerating pensions committee members better to take into account of the significant training requirements and the time involved in being a member of the pensions committee. So that's again a discussion point as whether you would like that left in or changed or anything else in its place. So I'm happy to take any questions on the draft consultation, but then following that I'd just like, if I may, just to come back and mention something about training and Lola, but I'll take the questions on the consultation first. Thank you.
Thank you, Chairman. On the consolidation issue, I think we have to be quite firm, actually, Chairman, because we have different views. Although we are in border to coast, even amongst our colleagues in border to coast, we have very different views, say potentially other border to coast members, never mind an entirely different pool. So I would be very concerned if we had an edict from government on high that said, oh no, you must consolidate with X pool, and we have nothing in common or very little in common in how we invest, what we invest in. And I think we need to be very firm on that. So no, we are compliant with pooling. We are doing what you've asked us to do. Actually, let us get on and do the job. That's why we're here, because we are there to make the decisions. If the government wants to make the decisions for us, then quite frankly, why are we here, Chairman? And it's getting to that level again, Chairman, where it sort of begs the question. You sit there, you read things, and you think, well, we're being told we have to invest X amount in this type of class, because I know that's in the document as well, which to me is a nonsense. Okay, if we have to have so much in pooling, that's fine, that's been established, but don't tell us what we have to invest in, because we're responsible for our own members, not His Majesty's government, because they're not going to foot the bill, Chairman, if it goes wrong. Finally, Chairman, on the issue of remuneration for pension members, I find this subject quite uncomfortable to discuss, because it's a bit like when MPs used to vote for their own pay rise, Chairman. I don't think that should be something that we should be doing as councillors. I think that's something that officers should determine, and if there is a rate, that is something that they set, but it certainly isn't something we should determine, Chairman, because it, as I say, feels very much voting for your own pay rise, which as a public servant, Chairman, I certainly couldn't do and wouldn't do.
Thank you, Tom. I think there's a question and a comment in there, Joe.
Yeah, hopefully I can answer what was required. On the consolidation, I think one thing that all the partner funds and Border to Coast, and from discussions with the Joint Committee, in answering the whole of the consultation, we've tried to be positive wherever possible, because our understanding is that actually whichever colour of party gets in after the next general election, this is the direction of travel that the government want. So it's not something that we think, well, actually, if we can ride it out till the next election and something changes, we might be okay. So what we've tried to do is to be as positive as possible, but highlighting the issues. So technically, it is possible to consolidate. The actuality of doing it, though, raises all sorts of governance issues. We've talked about we would need them to sign up. I've mentioned before the principles that we have as Border to Coast that the partner funds created initially and that were reviewed earlier this year. Any fund coming in or any, I think it's probably more likely that funds might choose to switch pools perhaps rather than a pool merger, because we're set up very differently. When companies merge, there's generally a lot of problems before it gets any better. So as an FCA regulated entity, I think that could prove very difficult. But there may be some funds that meet our like-minded stance, that have a similar culture to us, that could come in. Michelle and I had a meeting with Rachel Elwell, who's coming to the October meeting to discuss the strategy. And I think one of the things as Border to Coast partner funds is we don't want things done to us. We never have done. We've been on the front foot and made sure that we've developed Border to Coast as we wanted to. So I don't think, hopefully the tone in the fund's response is that whilst we can do this, there's all these considerations and it would not be easy. In talking to DLUC, they are saying, don't worry about the consolidation, it's all about the transition of assets at the moment. However, there will be views of some funds where they haven't transitioned assets that are thinking, why should I transition now if potentially I'm going to have to transition again in 3 years when you move me to a different pool? So there will be some people that will be coming back a lot harder that haven't yet put any money in, saying, let us work with our pool and actually make it work for us rather than trying to bring them together. On the 10% ambition for private equity that you mentioned, they've been very careful in their wording that it is an ambition and they are not telling us we must do it. However, we will have to explain if we don't, which is what they did on the previous consultation about infrastructure investments. Now, as a fund, and pretty much all of the partner funds, we're suggesting that you shouldn't just be looking at private equity, it's private markets, because that all feeds in. They've also not said it's got to be UK, it's global, and we're well over that 10% in private markets anyway. So actually for us, that isn't an issue at all. But for some funds, there will be an issue because the government don't seem to understand that private markets are higher up the risk spectrum, generally, private equity, which is why you should expect a better return over the long term. There's an illiquidity premium. Now, funds are turning cash flow negative. They need cash. So there is only so much of the fund they can afford to tie up in illiquid investments. It seems that it's been said that because you're well over 100% funded now, you can afford to take more risk. Well, actually, it normally works in the opposite way, in that you take more risk in a balanced way to get yourself to be 100% funded, and then you can potentially rein it back because you don't want to suddenly come back down to 60% funded. So all of the responses that I've seen, I've also been involved in the PLSA response as well, are saying that private markets as an asset class, as an investment class, are a great opportunity. Where it's right, funds will already invest there and have no issue with that, but it's not always right, so they need to just accept and understand when funds don't wish to do that. But as I say, they've been very careful in wording it as an ambition and talking about global and not UK. And I take your point on the remuneration. So I suppose the question is whether you wish to leave the comment in there about, because this is just going back to government saying there should be a consideration. And it might be something that would then perhaps feed into the good governance review, because I know how popular I am with my training policy, but obviously it is a really technical committee and we ask a lot of you. So it's whether you want no mention at all, and I'm perfectly happy to take that out and just talk about the fact that we already have training policies, because that's actually all the consultation is asking for, or whether you would like reference just to say that perhaps that consideration should be given.
Do you want a quick comeback, Tom?
Thank you, Jim. No, I'm happy for the comment to be left in, Joe. That's absolutely fine. I take the points you made, but in a way concerns me, because when they say, oh, well, you'll have to explain why you're not, that's one step away for, we're going to get a very big stick and we're going to tell you to do it anyway, because I know how government operate and how they think. And this is and as I've said, Chairman, this is becoming an increasingly I don't know how other colleagues feel, but this to me is an increasing frustration with how we have to operate and how we are governed. I won't go into a very laborious debate on ESG and all the rest of it, but that, to me, that is how it started, Chairman, and this is potentially, if the government wished to do it, another stepping stone along that way of being very prescriptive and actually hand-tying, as when actually they shouldn't be hand-tying, as it should be your as you always say, Joe, your primary responsibility is the members and make sure that he's fully funded and that they have their pensions when they need them. And that's what government should allow us to do. And actually, as is referenced in the document many times, is to actually implement the good governance project review anyway, because it's already actually there. They're trying to reinvent a wheel in a manner that actually isn't as good as that review, and they don't need to reinvent in the first place, Chairman. And I think that's important that we acknowledge that. Thank you.
Okay, thank you. Before I bring Mark in, yeah, very good comments there, Tom. I listened along with Councillor Alan Briggs and Mr. Steve Larter intently at the LGC meeting we had up in Leeds just a few days ago. And Theresa Clay, who is the pensions minister, or one of them anyway, could have driven me to sleep, to be quite honest. They were talking, or she was talking about, obviously, the transition of all funds by 2025, and a lot of my peers that were in there were saying that's ridiculous, you know. They also talked about we reach 50 billion as a pool. Well, we're over 40 billion at the moment, and it's fair to say that we'd probably reach 50 billion by 2025 anyway. Obviously, markets allowing, because you never know. I'd just like to say as well, as as one of the 11 chairmen on the Borders to Coast Pension Partnership Joint Committee, we all seem to think along the same lines on that committee. We've had a few new members recently, but generally speaking, it's been very non-partisan. It's not been, political in any way. This response that's going in has to be signed by all 11 chairmen, me included. So it's very important that if you want to make alterations to it, that you let Joe know during this meeting, because that's what we've been asked to do. And then we'll bring it forward. The 28th of September, coming up soon, is obviously our annual conference. And I've got a joint committee meeting in amongst those days. So please, if you have any questions that you want me to bring up on behalf of Lincolnshire Pension Fund, please do so at that time. I'll say no more. Mark, over to you.
Thank you, Chairman. I would just like to say that I support fully the comments that Councillor Smith has made in general in relation to this consultation and our response to it, and it does seem as though the consultation is very carefully worded, just as our response is very carefully worded as well, as it probably needs to be. My main concern is the pooling into bigger pooling areas, because I do feel that this committee, to a certain extent, has lost some of its impact as a result of the initial pooling. And if there's a bigger pool, I can see this committee being even less relevant to the whole process. And I think we probably all know, what sits behind this in relation to bigger pools, and eventually maybe one pool that can be mismanaged perhaps by the government at the time. So I do have concerns about that, and I do think it ought to be resisted. I think we've probably made the best of what we've got, what we had to do in relation to Border to Coast, and I rely on our chairman as well as the other chairmen to make sure that Border to Coast does what it's meant to be doing. But as I say, I do feel that this committee has lost some of its impetus and impact as a result of that initial pooling. I would say that I have reservations about additional money for pension committee members, particularly as, you know, in relation to the comment I just made about the impact of this committee. Yes, it's very time consuming, but a lot of it is just ratification. And I'm not totally sure we need extra remuneration to simply ratify, you know, things and decisions that have been made elsewhere.
Joe?
Thank you. I think take on board all the comments, and hopefully you'll see that you'll believe that they are reflected in the response as it has been drafted. The only thing I'd just like to add, following what Councillor Strengle said, is I've just seen that the papers for the joint committee have just come through this morning, so I will share those this afternoon with the committee. They will have the full response from Border to Coast in. So this is, as Councillor Strengle was referring to, if there is anything in there that you are unhappy with, please do let him know ahead of the 28th, and then he can ensure that those views are taken to the joint committee. So I will share that this afternoon with committee members.
David?
Yeah, so just say I'm not proposing to change any of the recommendations or any points in Joe's paper, but let's just say that there's a Hyman's response to the consultation that I've circulated to Joe. I'm happy to circulate that round. There's draft at the moment, but should be available in terms of their final response in the next couple of days. We also had a short webinar, half-an-hour webinar, to discuss some of the key points, and we can send a link to the recording of that, just if it's in general interest. The one thing I'll just touch on in terms of some of the points in the response, I think one of the ones is about clarity on the treatment of passive assets, and whether they're deemed as pooled or not, because the current wording of the consultation suggests they aren't. Interestingly, at the webinar that we undertook, we had a couple of audience polls, and one was about, you know, do you believe that you should put, there's a target date to pool all listed assets by March 2025, and 62% said no. And that might be due to that lack of clarity about the treatment of passive assets. The other poll was about, do you agree with the government's proposal to set targets or ambitions for levelling up in private equity investments? And the response was 82% said no to that. So just wanted to make a couple of points to that kind of wider context. Happy to provide that if it's helpful for additional information, but as I say, not suggesting any amendments or proposals.
Thank you for that, David. Yeah, certainly at that meeting at the LGC, I hope my colleagues, of course I admit to say Joe was there as well, but it's all about assets under management, you know, and they were trying to say whether, or she was trying to say whether the funds were delivering, you know, as they should be to actually make savings, etc., etc. The one thing that's come through from all the people I speak to in these conferences is that Border to Coast are number one. Now, that's no reason to be complacent again, but Border to Coast are well thought of. Some of the others are not so well thought of. And there was a question in there, well, there was a question not at that meeting, but one before it, one conference before it. We're talking about slimming down the number of pools, actually, to make them larger. And it's bandied around anything from 1 to the current 8. Now, 1 obviously wouldn't be manageable. And the question, I suppose, is we don't want Border to Coast to be diluted by bringing in one of the really poor funds just because they think slam them into Border to Coast and bring them up. What that could actually happen is bring us down. So I'm aware of that, basically. I don't think it's likely to happen, to be honest. But there is that feeling in the background. I could see the way Theresa Clay was thinking along those sort of lines. And there is a move to try and get the pools to move to 100 billion in the future. And, you know, we're way off that, obviously. And I don't think any of the others are anywhere close to that either. So I'll stop there. Any other questions? Yes, Peter?
Yeah, I think this question 8 sort of pops out at me really on page 108, which is, do you agree that funds should be able to invest through their own pool in another pool's investment vehicle? Well, we've got a comment there, supporting principle. So that means I imagine Joe and the team and everybody else has got some reservations there. You mentioned challenges, and I think the word control comes in there as well. And I'm referring to what the Chairman's just said about Board of the Coast are very strong at the moment. I just wondered really what your reservations are there, because I feel there are some, and it's something I think the committee need to be aware of, because that can, I think something like that can affect Border to Coast.
Joe?
Yeah, absolutely. I'm just trying to get to that question response. So on page 108, that's the response, that Border to Coast, or summary of the response. Again, in saying that they're broadly supportive, that was where it's about, it could be done, and there could be some benefits of perhaps having additional funds within the pool, but there is a lot of concerns raised. And on page 117 is the funds response. So within that, it does talk about collaboration has always been a strength of the LGPS. We've always done that. So there could be merits in it. However, several implications that need to be considered and the risks mitigated. So this is where it sets out issues about the propositions, the funding vehicles that we've developed within Border to Coast have been set up through numerous workshops and discussions with partner funds advisors, with Border to Coast and their investment professionals to meet the requirements of those partner funds. Now, if another fund through their pool wish to invest in that, they're kind of having to buy an off-the-shelf product. So they can't then come in and say, well, actually, I know you've had this going for 5 years and it includes emerging markets, but we don't want that. So can you change it, please? So it's how people come in knowing, well, we've agreed this is how we're doing it. So that's one thing that needs careful consideration. The other thing within that, the next thing, sorry, is about niche strategies. Some of the vehicles of Border to Coast have been constrained in the value that they can manage because they are niche strategies. They don't want 500 billion to put into this, or 500. You know, they have a limit as to how much they can invest reasonably without taking additional risk or potentially reducing return. So if more funds are able to come in and invest in those products, that's a real consideration, because then what's the knock-on impact for those original investors? What we don't want is what some asset managers do, is just Border to Coast become an asset grabber and just try and grow in size. There's also the cost model. So the 11 funds, as currently stands, we're all shareholders. We all own 1/11 of Border to Coast. Now, if another pool wishes to come in, that would come in as a customer. So we would need to think about, well, how does that risk then get split? Because as the shareholders, we are taking the risk. The customer can come in, invest for a year and decide to go. The implications of that being resourced up to manage that money, and then they've gone. We have different tie-ins as a shareholder than as just a customer with an asset manager. So that would need to be really carefully thought. How does that risk sharing happen? How do you compensate the shareholders for that increased lack of control of what's happening, basically, within the vehicles? So that kind of comes into the managing the demand as well that I talk about there, just managing all the cash inflows and outflows. Now, with 11 funds, you know, we don't always stay in an investment vehicle. We will rebalance, or we might have a strategy change and come out. But there's only 11 funds, and we're all in it with the same desire to ensure that Border to Coast works for all partner funds, and we get the benefit from that. So, as I say, it comes back to that standalone investor, in, out, the implications that has on maintaining Border to Coast and the performance that we want to see there. So there's a lot of things that we raise, but there was a general view across the partner funds and Border to Coast and the Joint Committee that we didn't want to just go in and say, no, this can't be done. Because we know it is, as I say, it is, all political parties are keen on growing the pools, and potentially it is so that they can use some of it to invest in growing the UK economy or their latest political intentions. but we're saying it can be done, but there's an awful lot of thinking that has to be done around that. So when Rachel comes as CEO of Border to Coast to the October meeting, she will be talking about some of this and some of the strategy and considerations about can Border to Coast grow, what would need to be done to ensure that that didn't upset the apple cart with the original partner funds, what's possible and what's not, and she'll be looking to kind of get your views and opinions on that at that time as well. So hopefully the comments that are in the consultation response from us as a fund have covered your concerns there to say about, you know, consolidation. It is physically possible, but there's a lot of things that need to be thought about and ironed out before that could even start to happen.
Thank you, Joe. Just for the newer members, basically, so do you understand that Border to Coast is a limited company owned, as Joe has just said, by all 11 partner funds. They're run by us, not them running us, okay? So just want to make that clear. I think on page 118, the last two paragraphs really answers that question as well as Joe has done. So those two paragraphs basically are talking about that question, and I think it makes it quite clear that, you know, if the issues could be overcome, it'd be easier to manage on a pool-to-pool basis rather than an individual fund-to-pool basis. That makes perfect sense to me. Now, these are all the recommendations that are going in, signed by all 11, but amendments can be made, as I rightly said before. Any other questions before we move on? No, thank you. In that case, we'll come back to the recommendations on page 105 that the committee consider, discuss and approve the draft consultation response on the consultation LGPS, next steps on investment. I think we've discussed that fairly well. So can I have a proposer, please? Thank you, Tom Smith. Seconder, Mark Allen. All those in favour, please show. That's unanimous. Thank you very much indeed. Moving on then to item 7, which is the consideration. Sorry, Mark, you want to come back?
Sorry, could you put your microphone on, please?
It's a confusion on my part, maybe. It's item 7 on the agenda front piece, but it's marked as item 8, I think. It's not on. It's not on my papers. Right.
I turned it off because, sorry. Right, let's start again. Turn your microphone off, Mark. Thank you. Item 7 is consideration of exempt information. And I'll just move on. It'll make sense to you now, Mark. Just bear with me, okay? In accordance with Section 100A4 of the Local Government Act 1972, the following agenda items have not been circulated to the press and public on the grounds that they are considered to contain exempt information as defined in paragraph 3 of Part 1 of Schedule 12A of the Local Government Act 1972 as amended. The press and public may be excluded from the meeting for the consideration of these items of business. Tom?
Thank you, Chairman.
Can I have an agreement that we're moving to exempt information? Please show. That's passed. Thank you very much. Tom?